doing, everybody? This is Kurt Henry at the Mortgage Center. We are mortgage brokers, and this is just a behind-the-scenes look at how we can restructure a mortgage to make it so that a bank will approve it versus, say, a bank that is declining it. So let's just say somebody, well, I've said in my past videos that typically, banks and lenders will look at this ratio, your monthly payments divided by your monthly income, in order to see if you qualify for a mortgage. And this needs to be less than 44% as a general kind of rule, depending on the situation, but for a lot of times it is around 44% that it has to be within. So let's just say somebody's trying to qualify for a $600,000 purchase price, and maybe they're planning to do $100,000 as a down payment, and then so the mortgage amount that they need is $500,000. And let's just say that the bank or whoever the mortgage person is saying, well, you don't qualify for that $500,000 mortgage. Well, what we would look at is of course, with regards to this ratio, the income is one thing, which I've talked about in my previous videos, but the payments could be another thing. So the payments that the banks or lenders look at is they look at the mortgage payment, which is principal and interest, that you're qualifying for, plus your property taxes each month, plus your heat each month, plus any other debt payments each month. So what we would say is, okay, so you don't qualify for this $500,000 mortgage. Is there any debt? So perhaps this borrower has some other monthly payments, like car payments or credit card payments or loan payments or whatever the case is. So what we could say is instead of doing $100,000 as a down payment, maybe we decrease that. So instead of doing $100,000 as a down payment, perhaps we change the down payment to $50,000. So that means that we actually need a higher mortgage amount of $550,000. And you might say, well, that makes no sense because that's not going to help any situation. But the thing is that the $50,000 that we just freed up here, we could take that $50,000 and we could say pay off some debt. Let's just say that the monthly payments on this debt are somewhere around $1,500 a month. Well, and maybe it's $50,000 of credit cards or loans or whatever the case is, and the payments are adding up to about $1,500 a month. Well, by asking for another $50,000 on the mortgage payment might only be, say, $400 or $500 more per month. Now, that depends on a few inputs and assumptions, but let's just say the monthly mortgage payment is only increasing by another $400 or $500 a month by asking for another $50,000. But by doing that, we're freeing up $50,000 in order to pay off debt. And if those debt payments are $1,500 a month, then the net effect is that we're decreasing $1,500 a month of debt payments, even though we're increasing the mortgage payment of $500 a month. So the net benefit is $1,000 a month that we're cutting off of this ratio. And that could actually decrease this ratio to make it so that the borrower actually does qualify. So that can be a little bit technical, but if you have any questions on that at all, feel free to give us a call. Number's 905-436-8010. Thanks and have a great day.